Hello friends. Today I'm going to be talking about ETFs, which if you're not familiar, they're a kind of stock that you can buy that owns other stocks. Kind of like a mutual fund where a fund manager would pick out all the stocks they think are going to be good and then they put them together into a package that you can then buy as units. So the question really is, if you want to buy ETFs, which ones do you buy? Because there's so many different options out there. And you can buy them based on territory, like, US market or Canadian market, or by like a sector, like semiconductors or, gold. It's endless, really. And so I wanted to make it so we could look at it in a way you can break it down to three basic steps. So the first thing is you got to make a spreadsheet so that you can keep track of like what you're buying. And I've done that for you. I'm going to link in the description a Google sheet that I made that actually is linked to the financial system using formulas, so you can actually see your page update in real time based on the current share price. It updates about every 20 minutes, but it's pretty great. And then the second thing is you got to decide on the weighting that you want to use for the different categories of ETFs. And then the third thing is you got to just start buying ETFs. First of all, I just wanted to look quickly at the different options out there for, if you get a managed portfolio or an all equity ETF, which is kind of like the basis of how things work. So if you look at this managed portfolio, this is a Wealthsimple account that I can just transfer money into, and then it automatically just invests it for me. So I have no idea what it's doing. It just happens in the background. But you can look at kind of the basic spread here. So US stocks, it says about 36%, Canadian stocks about 27%, EAFE, which is international, like not Canada, not US, about 18%, global factor 13%, emerging markets 6%. So you've got, basically between US, Canada, and international. So this is called TEQT, which is an ETF that you can buy. They call it all equity, and it's split up between a similar thing here. So you've got US equities about 53%, Canadian 24%, international about 21%. And if we look at Vanguard's example of this is called VEQT. You've got US is 45%, Canada is 30%, and then other is another like 25%. If we look at BlackRock's example, this is called XEQT, and it's a little bit harder to read here because it's split up into different parts for the US, but you've got US here at about 29%, and then another US about 16%, giving you that sort of 45 range. And then Canada about 25, and then everything else another 30, So that's kind of what I'm seeing here. There's a pattern where they all kind of have the same sort of basic, US is usually 45 to 55%, and then Canada's in there 20 to 25%, and then everything else. If we look at my ETF template that I've made here, it's got some really cool things we can use. So there's the stock on the side here. I'm trying to zoom in. I put TSE : because these are all Toronto Stock Exchange stocks, and sometimes if you don't put TSE : first, it doesn't pull the share for some reason. So I always do that. And so I've got it between US, Canada, international, and another category called high dividend that isn't like, if you think about stocks that pay high dividends, they exist, but that's not exactly what these are. These are more ETFs that invest in companies in the financial and energy sectors that do pay dividends. But what's cool about these stocks is that they grow similar to the other stocks in terms of like, US equity, but they don't seem to dip in terms of like when there's some kind of crisis, like a new war or something like that. I think they may, but generally what I see is they consistently just kind of go up, and I like that. So they are one of my sort of favorite alternate stocks to the typical big three. So in this, I'm going to link it in the description so you can just use this and copy and paste or whatever, but I'm going to just give you a breakdown of the formulas basically. So, I've written the sector here to make it easier for me to see what's going on. And then the share price, you can see here, it's got this cool equal Google Finance, bracket A2 price thing. So it's referring to A2, which is A2 is HXS. So it's pulling that share price in real time, or 20 minutes delayed whenever the market's open. And so the spreadsheet is kind of like alive. It's moving and it's fascinating. So I've got the quantity here, and then the market value is just like the quantity of shares times the current share price. So it moves. You've got the book cost. So this is something that you're going to have to put in manually as you buy more stocks. You have to look at the stock in your app or on your computer and see what your current book cost is, because that's like the actual price that you've paid. And then as you buy more stocks of the same name over time, you're going to buy it at different prices. So your book cost is going to be kind of random based on all the different various prices you paid for that same stock. I've got the return, which is basically like the market price minus the book cost, and then the weight. So this is like dividing the market value into the total value of all the stocks added up together, and then we can sort of then add those up and then see how much you have in any particular section. So, for example, of HXS, I have 14%. Of my total portfolio in that stock. And then these other US equity stocks, 7 and 24 and 9 and 3. And then they add up all together to be 45.7. And so that's the actual weight. And then you can see my target weight to the side here is 45%, which is based on those all equity stocks and that managed portfolio that I'd shown you earlier. So, and on the end here is the percentage of return. So it'll calculate for you, if you're up or down from your book cost, and the goal is that you want the whole thing to grow, right? So this isn't like my actual spreadsheet for myself. I just did this last night to make an example. So the quantities of stocks I had to sort of mess around with to get the weight to work so that it was similar. So I've got Canadian, I want 20%, but I got it to 19.4. International, I want to be 20%, I got it to 19.5. So as the stocks go up and down in value, and as you buy more, the weight is going to have to be sort of rebalanced all the time. But to put it simply, if I wanted to, let's say, buy another stock today, I had some money, I'd probably pick one of these ones that are below the target. So this one's at 19.4. If we just say let's buy another share of HXT, and I put this at 2. So now it's at 24%, which is higher than the target that I want, which is fine, because now I can go, okay, well, what's now lower? Now the US equity is lower, it's at 43, so now I can buy another one of those, or I can buy an international, that kind of thing. So over time, you're kind of just going back and forth between them to try and keep the weighting distribution on target. So yeah, it's pretty fun. Basically, I could go through all these, but I'm not going to. To put it simply, there are stocks like HXS, which is an S&P 500 US equity stock that is really based on the top 500 companies in the US and what it has its money in the different buckets of stocks. But then there's things like VUN, which is not the S&P 500. It's just all US. It invests even in smaller companies. So it's interesting to have all these, you could just invest in one US equity stock and one Canadian stock and one international and still get a weight similar to this if you wanted. But I like to spread it out a bit more within that category. So for Canadian stocks, I've got like a Global X example, I got a TD Bank one, a Vanguard one, a BlackRock one. And then so it just gives me a little bit more diversity. And you just never know like which stock is gonna grow faster than what other stock. You know, it's like gambling. However, this seems to be, I think, considering that this model is used by a managed portfolio or very close to this, it's a good bet. You know, better than just going like, I'm going to buy Apple and hope, I'm going to buy whatever the new big stock is and hope that it keeps going up. Like that's, to me, a lot more risky than just going, well, let's buy a big chunk of everything, and hopefully on average you're gonna win. So there you go. Please like and subscribe and leave a comment if you have anything to say about this. And yeah, be sure to check out the template and mess around with it and maybe make it your own. Thank you for watching, and I'll see you in the next video.